In 1913, a small group of the most powerful bankers in America met secretly on Jekyll Island, Georgia. They arrived separately using only first names. They came at night. They told no one where they were going. For 9 days, they designed a system so elegant, so invisible, and so permanent that over 100 years later, it is still running and you are still funding it every single day without knowing exactly how. What they built was the Federal Reserve. But the Federal Reserve is only the beginning of the story. The real story. The one that explains why banks never lose, why financial crises make them richer, and why the money in your checking account is not really yours in the way you think it is. That story has never been told the way it needs to be told. Until now. This is the Silent Tycoon. Let's start with the most important fact about banks that almost nobody learns in school. Banks do not lend money they have. Read that again. Banks do not lend money they have, they lend money they create. This is called fractional reserve banking, and it is the foundational mechanism of every commercial bank on Earth. Here is how it works. When you deposit $1,000 in your bank, the bank is legally required to keep only a small fraction of that. In the United States, this has historically been around 10%, though recent changes have reduced this requirement to zero intuitively and is free to lend out the rest. So your $1,000 deposit becomes $900 in new loans. Those $900 get deposited somewhere else, and that bank lends out $810, and so on in a chain that can ultimately turn your original $1,000 deposit into nearly $10,000 of circulating loans. All of it created from your original deposit, all of it charging interest, none of it existing before you walked in. This is not a conspiracy theory. It is not hidden. It is the documented, legal, fully disclosed mechanism of modern banking. It is taught in economics classes. It is described in Federal Reserve publications. It is simply rarely explained in a way that makes its implications clear. The implication is this: banks earn interest on money they did not have. They charge you for something they created at the moment you asked for it. And they do this millions of times a day across hundreds of thousands of transactions at interest rates that range from modest to predatory, depending on your credit score, your desperation, and your understanding of what you are agreeing to. But fractional reserve banking is only the first layer. The second layer is something called the interest rate spread, and it is where banks make the majority of their quiet, consistent, unglamorous profit. Here is the mechanism. The bank pays you on your savings account approximately 0.5% interest per year. In exchange for your deposit, which they use to create loans and investments, they give you 50 cents on every $100 per year. Then they take that same $100 and lend it out as a car loan at 7%, or a credit card at 24%, or a personal loan at 16%. The difference between what they pay you and what they charge borrowers is called the net interest margin. For the largest banks in the United States, this margin has historically been between 2 and 4% on trillions of dollars of assets. It is, by any measure, one of the most reliable profit mechanisms ever invented, and it runs every single day on every dollar you have deposited without you thinking about it at all. The third layer is the one that most visibly affects ordinary people: fees, overdraft fees, monthly maintenance fees, ATM fees, wire transfer fees, foreign transaction fees, late payment fees, early payment fees on certain loans. The average American bank customer pays over $300 per year in banking fees, often without a clear understanding of what those fees are for or whether they could be avoided. But here is what makes fees particularly significant from a wealth perspective. They are not random, they are engineered. The structure of overdraft fees, for instance, which charge $30 or $35 for a negative balance that may be only $5 is not accidental. Studies have shown that overdraft fees are paid disproportionately by people with low account balances, the people who can least afford them and who have the least ability to avoid them. The same is true of minimum balance fees, which penalize people for not having enough money in an account at a bank that is using their money to make more money. The fourth layer is the most sophisticated, and it is the one that allowed banks to both cause the 2008 financial crisis and profit enormously from its aftermath. It is the business of financial products. Mortgages, derivatives, securities, and the complex instruments that banks create, sell, and trade among themselves and with institutional investors. Without entering into the technical details of credit default swaps and collateralized debt obligations, the core principle is simple. Banks are not just places that hold money and make loans. They are financial product manufacturers. They take assets, mortgages, car loans, credit card debt, bundle them together, give them a rating, and sell them to investors. They earn fees for creating these products. They earn fees for selling them. And when the products fail, as they did spectacularly in 2008, the banks that were deemed too large to allow to fail were rescued with public money, the money of the taxpayers whose deposits they had used to create the very products that failed. This is not an accident of history. It is a structural feature of a system in which the profits of banking are private and the risks are eventually socialized. Where things go well, the shareholders benefit. Where things go catastrophically wrong, everyone pays. Now, I am not telling you this so that you will be angry. Anger is underproductive. I am telling you this because the people who understand how banks make money are the people who know how to use the banking system rather than be used by it. What does that look like in practice? It looks like keeping your money in high-yield savings accounts that pay 5 or 6 times the rate of standard savings accounts. It looks like paying credit cards in full every month, making you what the industry calls a deadbeat, a customer they cannot profit from. It looks like understanding the true cost of a mortgage and choosing a 15-year term over 30 when possible, cutting the total interest paid nearly in half. It looks like building assets outside the banking system, real estate, businesses, investments, so that compound growth works for you the way fractional reserve banking works for banks. The greatest irony of modern finance is this: the mechanisms that make banks wealthy, leverage, compounding, and the use of other people's time to generate passive returns, are available to you as well. You simply need to understand them, and you need to start using them on your own behalf rather than funding them for someone else. The men who met on Jekyll Island in 1913 were not villains. They were architects. They built a system that has functioned, expanded, and enriched its participants for over a century. The system rewards those who understand it and extracts from those who do not. You now understand it. What you do with that understanding is the only question that remains. This is the Silent Tycoon. Every week, one more door, one more truth, one more room that most people will never enter. Subscribe, and make sure you're standing at the door when it opens. Stay silent, build quietly, and own everything you touch.